stocks, when things go bad, they're bad, then they're really bad very quickly. It's the old Ernest Hemingway quote about how did you go bankrupt? Something like the traditional way, slowly then suddenly. So I would suggest that next year is probably going to be the tipping point. What we're seeing at the moment is actually what looks pretty much like a typical bubble. They come in two forms or two stages. The early stage is, hey, look, we've got this new technology. Everybody goes, wow, this is amazing. It's going to change the world. Everybody piles cash into it. You get these runaway sort of almost momentum trade as everybody else gets into it. And as it goes up, everything goes up, so it sucks in more money. And then everybody works out they've invested too much money. You get a bust. And then you get the second stage of the bubble, which is everybody doing really well, but just not the original investors. It's essentially, thanks very much for putting the infrastructure in, guys. That's brilliant. Now we're going to take advantage of all your capital that you've lost money on. We're seeing reductions in employment in the private sector. So the UK is a very, very peculiar policy mix. If I was going to design something that would lead to stagflation, I would almost certainly pursue the policies that Rachel Reeves is following at the moment. And in fact, if I wanted a rise in general populism, I would also pursue her policies. History tells you that pretty much everything she's doing at the moment is not going to end well.
Hello and welcome to the MoneyMagpie Invest podcast. I'm Jasmine Birtles, founder of MoneyMagpie.com. Before I start, remember that nothing that is said in this podcast should be taken as financial advice. It's financial information only. And do remember to subscribe to us, follow, like, comment, always comment because we always reply to the comments, and tell all your friends how fabulous we are. Right, got that out of the way. Now, my fabulous guest today is Ben Ashby, who is the Chief Investment Officer of the wealth managers Henderson Rowe, and he used to work for JP Morgan. And he has information about all kinds of aspects of investing, including the cycle that we're in. Hello, Ben.
Hello, Jasmine. Thank you very much for having me on your show.
Well, thank you for coming. And now, Ben, I'd like to start with the kind of top of mind issue at the moment, which is, are we about to be at the bursting of a bubble? Are we about to see a crash? Are we at that point of the cycle?
Given I'm a half a step in the academic world, I can tell you from academic papers alone, timing the end of a cycle is incredibly difficult. So the one that most people seem to be saying this one's closest to it is the dot-com bubble, and there are certainly some echoes. The point I would make is if you look at 99, you were looking at an environment where the Fed was likely to start tightening rates and reducing liquidity. You've got a very different Fed at the moment, which is talking about the exact opposite. So I would say potentially this thing may have another leg to go in terms of upwards. The other thing that's worth looking as well, because the stock market in the US, which is what most people focus on, a lot of the extreme valuations are actually concentrated on a relatively small number of companies. Now, admittedly, these companies are extremely large, but outside of that, some of the other valuations in the US is actually not that extreme. So when you're looking at most metrics, yes, the index does look very expensive, and that is dominated by these certainly smaller number of larger mega caps and a few other firms that are certainly associated with the AI bubble. But like I say, away from that, it's a bit hard. Where I think you've got perhaps a different bubble to look at, I think, is probably in debt. And you've got ever increasing amounts of government debt, particularly from the United States. And you've also got a huge amount of risky credit leaving the mainstream banking sector and moving off into the shadow banking sector, or private credit, as they like to call it these days. And you've got 30-year tights, so how expensive credit is. So again, most of those things are suggesting that that is probably where I'd be most concerned in the short term.
Well, quite. I mean, I was going to say, as far as I'm concerned, I'm not thinking 99. I'm thinking the 70s, and particularly the debt problem across the board. I mean, across the world, not just America. America is staggering. But, you know, here in Britain, China's over indebted. Everybody, every single country of any note is over indebted. So that does seem to me to indicate quite a big pop that's going to come at some point soon.
I would agree with that. I'm glad you mentioned China because it never seems to get mentioned by most people. But if you look at most of its debt metrics and the size of its estimated deficit, it's actually quite an extreme outlier. So I would agree with you. And I think probably the 1970s is your best sort of like template for this. The only way they're going to get out of this is through inflation. They are going to devalue the currency. The question is how quickly the currency gets devalued and in what way. So that's what I suspect is going to occur. Inflation tends to come in waves. I suspect we're probably going to get another wave, certainly in the US. But the one thing I would caution is there's very different economic dynamics around the world. So China, I think, is actually looking at a deflationary bust. And I think there's going to be problems with deflation in some parts of Europe. The UK sits somewhere in between, but I think the US is definitely on an inflationary trajectory.
Yeah, well, quite. I mean, it seems in this country, inflation is and has been for a while the way to go. I mean, you know, officially it's 3.8%, but in lived experience, it seems to me to be more into double figures, really. Although when I was in France last week, I noticed that their inflation is officially 1.2%. And talking to people, you know, on the streets, people that I was staying with, they were saying, yeah, I haven't really noticed much inflation. So I'm wondering, you know, usually inflation is something that's done deliberately, as you say, they're going to devalue the currency. Is this being done deliberately in Britain to devalue the currency?
I don't think we've quite hit the currency devaluation point, and I know there will be probably people listening to that online going, but look at all the QE, and we can talk about that separately. But inflation is largely who you are and what life you live. It's a single number to try and identify a basket. So your lifestyle actually dominates how your lived experience, to use your expression. So certain cohorts are definitely seeing marked inflation in their lifestyle. Other people are actually benefiting from it. The other thing to remember as well, how you calculate inflation, is it comes in two halves. One is the goods basket. The goods basket is actually going down in many parts of the world. Why is that? Because China's massively overproducing stuff and dumping it onto the wholesale markets. And you know that is occurring because you can see even the European Union's beginning to put up trade barriers. I think the European Union will be following the US into basically more tariffs on Chinese goods because it is effectively social dumping. So when you look at that kind of wider basket, you can see that certainly there's goods pressure on the downward side. The UK has pursued a very unusual policy mix, which I think is the most polite thing you can say about it, where you've got the public sector benefiting from large pay hikes, which are largely unearned from the overall economy and the GDP performance. But actually, you're seeing marked downward pressure in areas, certainly in employment, given the numbers when we're recording that came out yesterday. We're seeing reductions in employment in the private sector. So the UK is a very, very peculiar policy mix. If I was going to design something that would lead to stagflation, I would almost certainly pursue the policies that Rachel Reeves is following at the moment. And in fact, if I wanted a rise in general populism, I would also pursue her policies. History tells you that pretty much everything she's doing at the moment is not going to end well.
Well, that is, as you say, you know, the way that I think as well. We're beginning to see the startings of stagflation. We certainly have stagnant economy, stagnant property market, stagnant jobs market going down, as you say, and yet we've got inflation, we've got food prices going up. And I am concerned, and I'm guessing you are, about what's going to come up in the autumn budget. What do you feel about it?
She's going to have to raise taxes again, but the fundamental problem you've got from the UK is two or three things. One is a real fundamental problem with productivity. And as a famous economist once said, that productivity doesn't mean much in the short term, but it means everything in the long term. and it's effectively doing more things with less resources. Well, we've managed to fail to do that for nearly 25 years. The main reason is because as the public sector's got bigger, it's roughly operating on year 2000 levels of productivity, which in a way is quite remarkable. You know, you've resisted the internet, sort of like websites, AI, pretty much every sort of innovation has been thrown at it, and it's still just as productive as it was around 2000. I believe I've been reading the paper that Starmer's going to try and blame Brexit for that. But I would actually push it the other way around and say, well, actually, if you look at the opening of the borders, that's potentially when the business model of the overall country started to shift, and you start to bring in cheaper labour, not necessarily for higher productivity gains. One of the things that tends to drive productivity gains over time is the cost of labour. So firms actually will go out and try and do things in more innovative or productive ways. We started to pursue a different business model around about 99, 2000. People can argue whether that was a good thing or not, but for productivity it wasn't. Plus we started to load the economy up with a lot more regulation, which again is generally not particularly conducive to higher productivity. So I would argue that's probably when our problems started. 2008 and 2009 and the popping of the the financial bubble and the GFC pretty much showed that actually everything we've been doing for the last 6 or 7 years had largely been debt-based, and really there was underlying stagnation going on. And I would argue pretty much everything since then has been a continuation.
Hi, I'm going to quickly interrupt this amazing podcast to let you know that MoneyMagpie Invest has a bi-weekly newsletter where we share tips, tricks and insights to help you become a more confident investor. Our newsletter is completely free to sign up to, and it will arrive in your inbox on Saturdays at 12:30 p.m. As well as all of the super useful investing information, we also share exclusive deals from our partners. So if you're serious about building long-term wealth for yourself, I really recommend signing up. And you can find the link in the description of this podcast.
So back to my original question, and I know it's very hard to pick a date or anything. I mean, do you think we've got another few years to go, and sort of it's still a continual slide? And I say I'm talking about really the West, or the world, really world economy. We've got another couple of years to go before things really go bad, or could it happen at any moment really that things just blow up?
If we start off with the West, I would start with the United States. So it's nearly a quarter of the world's economy. It's nearly half the world's equity markets at the moment, which is always a healthy looking sign. I think it's more likely you're going to see problems with them next year. And if you were going to ask what I think will start to pop things, it'll be just higher rates. And my background is fixed income. I'm more of a macro trader than anything else, but it would be unusual to see that inflationary push come through this side of the year. A lot of businesses have stocked up in advance. They knew tariffs were coming. They're busy running down those stockpiles. One of the reasons you've got actually quite marked profitability in the States, and particularly out of the US banks, is because having been, as you pointed out earlier on, a JP Morgan banker, they've done well out of a number of things, raising more debt for companies during the windows, but also lending people working capital, because as they expanded their inventories higher than they would have normally done to basically absorb this stuff before the tariffs kicked in, they made money out of that. This all starts to work off towards the end of the year and into next year. That delayed effect of tariffs will start to feed through in US prices. If you look at the US, pretty much everything you would want for an inflationary environment, they are doing. So they're trying to reverse globalization. I actually think there are some good reasons for why they should want to do that. I would have possibly suggested 4 to 5 years of phasing things in, not in an afternoon and giving nobody much warning. You're also reversing a lot of the migration trends that you had in the United States. So again, that will put pressure on wages ultimately over time. And you're also reviewing some of the other parts of, say, the visas, so the H-1B visas, the high-skilled visas in the US, particularly in the tech sector, where there was a strong tendency to bring in US and to a lesser extent Chinese workers, which are generally much cheaper. They have to work for that firm for 5 years. They can't really move. So you actually get a big cost advantage on that. And Trump's obviously trying to reverse that as well. So you look at every single moving part of the states, plus the pump priming, which is the difference between what they're spending and what they're bringing in taxes. It's a pretty much perfect mix for inflation. Now, the next question you have is usually, and I spend a lot of time doing what they call non-linear dynamics. When things go bad, they're bad, then they're really bad very quickly. It's the old Ernest Hemingway quote about how did you go bankrupt? Something like the traditional way, slowly then suddenly. So I would suggest that next year is probably going to be the tipping point. I thought there was a chance it might be the tail end this year, but I actually think most of this will probably now feed through into next year. Every time we see the Americans run into a liquidity problem over the last sort of 15 years or so, they've injected more liquidity into the market. If you look at Powell's comments, even though that none of the data really justifies it, he starts talking about rate cuts. He starts talking about the US labour market, even though obviously there's net emigration at the moment because of the policies that Trump's pursuing. But he talks about that's his main driver. And it's a difficult case to make, but that's one they made it, and it looks political.
It does. And I'm just thinking about, as you mentioned, basically bringing the dollar down deliberately, and understandably, I do understand that, but this does again bring us back to gold. A lot of things seem to bring us back to gold and commodities, solid things, as we're seeing fiat currencies, particularly with the dollar, the main one, be devalued, the pounds would be devalued, all of these. Do you feel that gold is a good place to run to, or is that not your bag?
I have very mixed feelings about gold. So full disclosure, I wrote an article last year for a magazine, which was recently reprinted. I've got a substack, which isn't an advert. It's just if you want to follow up, that's where I sort of stack everything. But that explained where I thought gold miners would be a good place to invest. And that's obviously done very well over the last 12 months. But the Substack's also got some caveats which you can't always fit into a sort of article explaining the weird and wonderful history of gold. The thing I would just point out is gold has two qualities to it. One is it's a very much behavioural good. It's got something like total usage outside of basically human speculation is 6%. So it's really got not a lot of industrial purposes. It's just us semi-evolved monkeys like the thing, and we've got 6,000 years of history showing that us semi-evolved monkeys like the stuff. So there's a tendency for us to run to it when we have problems. History tells you that actually gold can be inflationary and deflationary. It just did very well in terms of timing over the last 200 years, but there have been marked periods of time where actually it's had completely the opposite effect. The second thing is just in the short term, there's been a lot of buying of gold, and I'm not sure how many people actually genuinely thought the thing through. And if there was going to be a, say, wider liquidation, I think there's a good point that you would see these people are forced to liquidate their positions, which is exactly what happened in 2008 for us that remember that, again, everybody thought the banking system, or at some point, people realised the banking system was going, people rushed into gold. But once actually things started to fall apart, people started to get margin calls, all the leverage investors, the hedge funds of the world and various other points. And they were forced to basically liquidate what people wanted to buy. And that wasn't subprime mortgages, it was gold and other safer securities. So I would just caution everybody that anybody that wants to buy gold wants to be buckle in for a long and probably very volatile ride.
Oh, that's very interesting. Yes, I hadn't thought about the liquidating it for that reason, but that happened in 2008. It could happen again next year or the year after, something like that. That's good to know. But
can I give you a slightly older example? I went to see the Federal Reserve in my former life in December 2015, and I came out of, it was their New York branch, and I remember just thinking, you are not going to stop printing until you get inflation, and you are going to get a lot of it. And I started to buy for my own personal account gold mining companies then. They went up about 78% in 2016. You'll be able to check this. And then they gave most of it back over the next 2 or 3 years. But if you look from my original point of investing to where I am now, that's made about a 24% compounding return in sterling. But just have a look at the volatility that I would have had on that position. And that's what I'd just caution your listeners to. Just be prepared. This stuff can be incredibly volatile. And there was an enormous bust in gold in the early 80s because once the Americans started to deal with inflation, again, gold got crushed as a result of it. So I don't think we're at that point, but I would just say there's a lot of almost panic buying. And that's the second point I was going to make is they call it a Geffen good. So when it goes up in price, it's seen as more desirable. Well, traditional economics would tell you the opposite would happen, but I have a lot of feelings about traditional economics and most of them wouldn't align with what most traditional economists think about the world. But I would just say, look, it's going up. Everybody likes it. It's acquiring a lot of other stuff. I would just be cautious.
Even though so many of the central banks are hoarding it, do you think they will need to liquidate it if everything goes bad?
Well, the first point I would say is central banks haven't exactly covered themselves in glory doing their day job, which is just keeping the money in control over the last sort of 10, 15, 20 years. So them suddenly turning into precious metals speculators would also not necessarily suggest they know what they're doing. The main reason you would need this stuff is for settling of international trade. And if you're not happy with the dollar or the euro, which I think has an undeserved ride over the last few years for what is still incredibly flawed currency. If you are worried about the ability to use those currencies to settle your international trade positions, then potentially gold has some value to it. The trouble is gold is a really clunky asset to settle international trade with for central banks. So I get where China and other non-aligned, shall we say, central banks are doing it after the basically taking over the reserves of Russia. But for some of the other states, it's a little bit more murky about whether they needed to do it. It's either because their own currency isn't suitable for settling those trades, or they have some kind of concern about the other stuff they have. Would it be able to be used?
And if I could just go back to something you said earlier about the American stock market having basically a handful of big whales, essentially, some huge, incredibly successful, unbelievably successful companies, some of them bigger size than a few countries put together. One of those, of course, is NVIDIA, which has done amazingly well. And I know that you've been watching a lot of these. I mean, they're tech companies, let's be honest. Primarily, we're talking about the big tech companies. Do you think that they are going to continue to be the saviors of the world, or at least, the saviors of the US stock market? Or are we looking at some of those tailing off and potentially triggering a crash?
It's usually always the biggest stocks in the market that will cause the most pain to the most amount of investors. So going through them, we have lived in a very unusual period since 2008 because it is very unusual for large mega cap stocks to outperform everything else. For the obvious reasons, you get diseconomies of scale. Now, tech companies are slightly different for a couple of reasons. They have network effects, which is something that, again, traditional economics never really takes into account. So again, once you build up a network, think of Apple, it's very hard to break into that as an outsider or indeed even replicate it. But also the Americans have had a very lax regulatory environment. So again, Google's going through, or Alphabet as we should now call it, but Google's going through a series of legal cases at the moment about how you've completely ended up dominating the advertising space in every way and form. And that doesn't look particularly great. Of the large cap stocks, the one I would be most concerned about would be NVIDIA. They're earning supernormal profits at the moment. Pretty much every one of their competitors is trying to get into that space because of the supernormal profits. And you've also got the issue as well that it's unusually even their own clients are looking for alternatives now. So a lot of the large hyperscalers in the States are also developing their own chips. So I would view it as a leveraged bet on the artificial intelligence market. But I think there's a very good case to make that it's probably going to be the biggest loser if somebody else has a technological breakthrough or actually just the slowdown that goes through. In many ways, we've seen AI at the moment. So we didn't really discuss it, but on the podcast. But as you're aware, I sort of sit on the board of Cambridge University's Centre for Financial History. So what we're seeing at the moment is actually what looks pretty much like a typical bubble. They come in two forms or two stages. The early stage is, hey, look, we've got this new technology. Everybody goes, wow, this is amazing. It's going to change the world. Everybody piles cash into it. You get these runaway sort of almost momentum trade as everybody else gets into it. And as it goes up, everything goes up. So it sucks in more money. And then everybody works out they've invested too much money. You get a bust. And then you get the second stage of the bubble, which is everybody doing really well, but just not the original investors. It's essentially, thanks very much for putting the infrastructure in, guys. That's brilliant. Now we're going to take advantage of all your capital that you've lost money on. So the two classic examples of that is obviously .com, where all these people piled in with fibre optic cable. A lot of those telco firms, as you know, never got their money back. I think Global Crossing was the most famous of the time, but you had WorldCom, a few others, all had the essential same problem. But everybody did really well afterwards because actually you'd built all this fibre optic cable. It was now dirt cheap because all the original owners had gone bust. So the creditors were basically prepared to sort of license it out for whatever price they could take. And that allowed to trigger the next phase, which was obviously a lot of firms that nobody had previously heard of, like Alphabet, Google, Facebook, and some other characters. Same with the railways. Again, that was probably the biggest bubble the British have ever seen. Ended up being a big percentage of our GDP. But when it busted, again, everybody suddenly benefited from having railways a lot cheaper than they had to be, and the original owners never got their money back. So I think we're in that first stage, which is the kind of what they call installation phase or frenzy phase, depending whether you're talking about the infrastructure or the investors. I think we're heading to a point where the maths don't work on the investments that they are making. And the trouble that they have, particularly the tech firms, is most of them, with the exception of Apple, don't want to get involved, or have to get involved, I should say, because they're worried if they don't get involved, they're going to have obsolescence. Whoever wins is going to win, or when their business model is suddenly wrecked. Of the big players, probably Google or elements of Google is the one at most at risk, because if you think about it, with ChatGPT, why do you want to use Google search going forward when you've got something that could be a lot more targeted? I'm not entirely certain what Meta Facebook is going to get out of it, apart from even more spammy messages that might be slightly better directed, but I'm not entirely certain. But they're spending a huge amount of money, and I would caution investors to say that they also thought virtual reality was the next best thing, and they had to do a huge write-down of that investment as well. So it's not like they've covered themselves in glory. So I would be concerned about that. What is different is they largely using cash flow to do it, which is unusual because often debt is used. Now, we might start getting to the point where debt's being used. Where debt is being used is the private equity space building out data centers.
It's, listening to you talking about, we talked about gold, we're talking about the big tech stocks, we talked about gold miners. I think, the question a lot of people are asking is, where shall I put my money? Where can I put my money for it to be safe, and keep up with inflation? What are your views as Chief Investment Officer?
The biggest problem I have to deal with is patience, and it's usually clients' patience, because if you sort of turn around and say, look, you really should hold off. There's a very well-known sort of parable in the city of a unfortunately now dead fund manager called Tony Dye, who was at a firm called Phillips & Drew, and he correctly predicted the dot-com bubble. And he stepped out about 97, 98. Obviously, the market roared away to new highs, and I think he got fired about 2 weeks before the market collapsed, and he obviously had to go off. But not one of those clients came back and said, oh, sorry, Tony, you actually called this right, and you would have saved us a load of money. There's some really good research by Schroders, by a guy called Duncan Lamont. So the first thing is cash is useful for short periods of time, but cash is government debt, and they are going to devalue it. So I would just say that history would suggest a basket of value equities is not necessarily a bad place to hide for maintaining your investment over time. The trade-off is you are going to have significant volatility. But again, there are relatively cheap companies in the market that have decent assets. Some of them, the reason why they're cheap is because they're doing things like tobacco, which isn't everybody's idea, but they're highly cash generative, and they would actually do relatively well in a inflationary environment for various reasons. So that is what I'd potentially suggest is international diversification, a bunch of sort of relative value equities, and just don't look at your investment statement too often.
Well, good. That's kind of the way I like to do it. Just stick the money in, leave it there, go off and do something more interesting. So that really genuinely is probably the safest way to go.
Yeah, there's a lot of evidence that suggests as long as you're not necessarily pursuing the bubble itself, there's a lot of value in just sitting there and being really patient. But most people can't be patient.
Absolutely. Ben, thank you so much for talking to us. Hope to get you back again in a few months' time, and we can revisit some of the predictions you've made and see where we are. I mean, 6 months might be a bit too soon. If we're going to be more patient, maybe we'll make it 12 months and go, right, a year ago you said...
How about 3 years? I'm usually right. Can I just finish with one thing about
Yes,
there's a research paper called "Even God Gets Fired Twice," which, apart from sounding vaguely blasphemous, but if I just explain where it comes from, it's like if you have the perfect vision of God, you know what is going to be the perfect asset over the next 5 years, and you bought it today, you would be an absolute winner. Everybody think you're a genius, but actually the research tells you get fired not just once, but probably twice, because the investment market at best looks on an 18-month time frame. So a very simple example of that is Amazon. If you bought Amazon stock around 2000, 2001, it went on to lose about 97, 98% of its value, which would probably get you fired as a fund manager. I'd be very surprised if it didn't. But actually looking forward in a 5-year and then 20-year view, it was a brilliant investment. That's the problem your clients have to kind of deal with. The next 18 months, it may well be that this carries on, but on a 5-year view, it's probably not where you want to be. And the statistical chance in US equities, based on history, of making anything less than zero over the next 10 years is small. Or making more than zero, I should say.
Making more than zero, exactly.
Yeah.
That's a bit sad, isn't it? So we've got to watch the equities. But as you say, for the moment, being in the basic value products, you're pretty much okay.
I think so. The UK stock market's quite cheap. It's just I can't give you a catalyst for why it's going to perform over the next 2 or 3 years, other than the currency is going to devalue, and the FTSE tends to do quite well in devaluing societies. But sentiment isn't going to change, and I suspect the current administration, I've sounded rather political, but the current administration is likely to contribute to continued negative sentiment around the economy.
Yeah, sadly, I agree. Well, Ben, thank you so much for that. That's really helpful. This has been Ben Ashby, Chief Investment Officer at Henderson Rowe, the wealth managers. I've been Jasmine Birtles. I'm the founder of MoneyMagpie.com. As I said at the beginning, make sure that you subscribe, you're following, you're commenting, you're telling all your friends, and I'll see you again next week.